Hey everybody, it's 3 o'clock, it's Tuesday. That means it's Tech Tuesday. Thanks for joining me today. I am Rick Uzzi, and today I'm going to be talking about some of the latest news with video streaming, things like OTT, IPTV, etc. I'll be right back. Thanks again for joining me again. I'm Rick Uzzi here at Z-Quorum, and I'm going to be talking about IPTV today. OTT, OTT is over-the-top TV. IPTV, of course, Internet Protocol TV, and some of the different types of that, and really what's going on in the news. So I'll be showing lots of news stories today, and I mean, this is stuff you could read yourself, but I'm going to try to kind of consolidate it all and add some context, maybe some commentary on some of these things. So let's get started. See what's happening. So this was the big story that I saw today. Actually happened yesterday. So T-Mobile was going to be launching a service. This would be in what's called lots of acronyms here that you'll be hearing. VMVPD, which is Virtual Multi-Channel Video Distributor or Programming Distributor. So it's basically like a standard, what they would call an MVPD, which would be like your traditional cable company or satellite TV, that kind of thing, but virtual. So they were setting to launch that, and just after 6 months or so after the launch, actually they were already launched, they've decided to shutter that. So you see here, just after 6 months they did that, and Wireless Care cites the financial challenges of its TV software provider, MobiTV. It will now bundle YouTube TV and Philo. So YouTube TV is another VMVPD, basically virtual cable company, so to speak. So they're going to now bundle YouTube TV instead of creating their own, and as well as Philo. So it says T-Mobile announced Monday that it will wind down T-Vision's Vibe and Live tiers on April 29th. I'll explain those here in a second. As part of a newly announced broad-ranging deal with Google. The wireless company has tapped Google's virtual MVPD, there's their VMVPD, YouTube TV as its official premium pay TV service. T-Mobile will also promotionally bundle another VMVPD, Philo TV. So the difference there is Philo's got a more stripped down version of content where YouTube is trying to provide everything that you might find in a cable package, and that's what T-Mobile was planning on doing with their T-Vision service. So they've basically taken these two existing providers out there, and they are going to bundle those in with their service. T-Vision Live and Vibe customers can get $10 a month off the $65 a month YouTube TV, and that's what YouTube TV is these days. So they're going to be able to get that for $10 off. And they can get $10 off the $20 a month Philo services as long as they're T-Mobile customers. So Philo is $20, again, that's a trimmed down set of content. So T-Vision Live customers, which was going to be more like YouTube TV, will get a month free of YouTube TV, plus a month gratis of the $12 a month YouTube Premium. And Vibe customers will get a free month of Philo, because Vibe was going to be more like the Philo TV, a trimmed down offering. It says here, for starters, T-Mobile learned that there's a reason the linear pay TV companies it has mocked for so many years are weighted down by so much of their programming contracts. They wanted, again, to have this $10 a month entertainment-only package like Philo, called Vibe. Almost immediately, programmers, including Discovery, pushed back, demanding that their networks not be confined to just Vibe. So that's one of the issues that all MVPDs suffer with or struggle with, whether they're virtual or not, whether it's a satellite company, cable company, or some of these internet-based TV services. So they have these conflicts with the programmers. The programmers want, of course, they're charging more and more for the programming, but then also they want to determine or dictate how their channels can be placed on these different tiers and what has to be bundled together, that kind of thing. So T-Mobile is struggling with the same problems, and that was just one more reason, I think, that they had an issue here. It says T-Mobile undoubtedly avoided lawsuits by adding 33 Vibe networks to its base Live bundle at no extra cost to customers, but it seemed to sink its economic model in the process. So originally they had to then take some of these things that they were offering for free and put it up in the Live version, and that kind of shot things down. But then the real big thing was in early March, MobiTV, the provider of the video software on which T-Vision is based, announced its bankruptcy. and that its largest company, T-Mobile, was giving it $15.5 million in bailout money. So when this happened, it was announced that they were going to be getting this bailout money, and everybody speculated, could that be T-Mobile? And then the answer came out, yes, it is T-Mobile. So now the question is, will T-Mobile be, do they already sink that money, or are they going to be pulling that back, and what impact will that have for Mobi? Because Mobi is basically, they have middleware service that a lot of smaller operators, not like Comcast and folks like that, but some smaller operators, TV cable companies might use, and a lot of folks that are doing IPTV that are rolling that out would use to be able to get programming content in some cases. I think they offer programming, maybe not. But they have the platform, the middleware platform, and they have a cloud-based model where you can go on just their hardware, so you don't have to invest in all the hardware. So I think they're not about programming as much as the middleware, like I say, and then the hardware that you can get. You can get your own with Mobi TV, but you can also use their cloud so that you don't have to buy all the head-end stuff that you would need to be able to offer this IPTV service. So it'd be interesting to see with Mobi whether that's going to make it difficult for them to come out of bankruptcy. And then the other thing was, and then there's the whole notion of fixed 5G being a legit competitor to cable. So that's what T-Mobile was looking to do, was they're rolling out 5G service, and they thought, well, this TV service could be something really good to go on top of that. But the issue there is that 5G, again, it's going to be, as I've talked about in the past, it's going to be something that is going to be high speed, more prevalent in urban areas, so it might be something there. But as far as other areas, it's going to be slower, and it's going to be harder to make a play, let's say, against a cable company in certain areas. So it doesn't seem like 5G right away is going to be making a real competitive threat to cable. And if you're only looking at your 5G customers being your market, and that's all you can really promote, or where you're most likely to have success, then that looks like that might be another reason that they may have pulled back there. Pandemic has revealed that wireless companies might not have the network capacities to come through on this challenge to cable's wireline market share. So it's going to take some time before 5G becomes a competitor, especially in certain areas. Wherever there's good wired service, it's going to be difficult for them to get a foothold. What else do we have here? So I thought this was interesting. So VidAngel rebrands as crowdfunded Angel Studios. So it says embattled OTT company spins off filtering business to focus on streaming. So VidAngel, if you don't remember that, that's a company that does filtering of content for, more like Christian markets, for example. So they'll filter out, they'll take a movie and they'll filter out bad language, nudity, maybe excessive violence, that kind of thing. And how they were doing this was they were actually getting the DVDs, and then they had technology that would filter all that stuff out. So I think I'm trying to remember if they were the ones that had the player that would do that, or they just streamed it. I think they were actually streaming it. So they would get the DVDs, have a technology that filtered that out, and stream it. And they had pushback from some folks there. And because of that, there was a lawsuit, and went into bankruptcy, I believe. So, but they're coming back, and it says VidAngel has spun off its filtering business to focus on crowdfunded online video production under the rebranded moniker Angel Studios, citing the success of its crowdfunded hit The Chosen. And I watched that. I thought that was great. So The Chosen is a story about Jesus that was completely crowdfunded. So you could watch it, you could pay it forward so somebody else could watch it, and it's now been funded through, they funded the first season, and they funded the second season, which is going to be, which is already shooting, I believe, going to be released this spring, actually. Angel Studios is crowdfunding a $5 million investment in the new operation. Money, it says, will go to building its Angel streaming app, expanding the crowdfunding platform it has used to fund its video projects, marketing platform, and in a bit of payback, help take creative control away from Hollywood. Because again, Hollywood kind of tried to stomp on them when they were taking some of their videos, which all they were doing was basically stripping stuff out. It's not like they weren't paying for the rights to that, but they were stripping out some of that and changing what the videos were, kind of like you'd see, actually. I mean, if you watched it on regular TV, they'd be taking a lot of that stuff out, right? So it's already done, but VidAngel was doing this in a streaming kind of format. So at press time, they'd raised over $3 million toward its goal. According to Angel Studios, its 2020 VidAngel revenues topped $47 million, with streaming original content revenue outstripping filtering revenue almost 10 to 1. So one of the reasons they're doing this is because they're moving in this direction of this streaming original content. We tested the crowdfunding concept with The Chosen, which has surpassed $30 million in revenue in season 1 in 2020 alone, funded the production of the next season entirely from sales, and prepared season 2 for release for this spring, as I said. So, and you can see how they're doing. So it said they had raised $3 million as of that story, and now they hit their target, it looks like. So I think they were trying to get $5 million because they got $5 million max here, and that's what they've received out of 4,682 backers. So that winds up being about $1,000 a backer. So that's pretty. They've got some big backers there, but it's all crowdfunded. I know they got a lot of small backers as well. You can see here they've got their other content that they're trying to get going. Some stuff that's been backed or being backed. Looking for 500 minimum there. They're about halfway there. This one may have just started. They've got 28 backers. They're at 5,000 approximately. They need about 100 minimum on that. And you can see what they're getting interest on here. A couple other series, and then there's The Chosen, which I mentioned is now fully funded. So they reached that, and they've got something else here that's been fully funded. So they're doing it in a really interesting way with this crowdfunding, and it's a very niche market. So they can take advantage of that market. I don't mean take advantage in a bad way, but they can leverage that market to bring out content that market is looking for. Let's see what Netflix is doing here. So this is really interesting. So Netflix is losing $6 billion a year on password sharing, analyst says. So I think everybody knows that people do that. I don't think I realized how many people did that. City analyst Jason Bazinet says illegal sharing of subscription streaming services is a $25 billion a year problem for the U.S. operators. And the top SVOD, that's subscription video on demand, owns 25% of it. So they're saying Netflix is 25% of that $25 billion a year problem. As streaming services move to center stage, thwarting this theft will be of growing importance for shareholders. And shareholders now are starting to look at these companies, and as we'll see here in a minute, some valuations are being adjusted. So shareholders are looking at these companies, and it's very possible that some of this news maybe has impacted their stock as well. This not necessarily Netflix, but just streaming in general. The City analyst estimate comes 10 days after Bank of America published a note suggesting a substantial percentage of streaming subscribers are sharing their authentication credentials with friends, family, and hangers-on outside their homes. Research from firm Magid said that about a third of all SVOD customers share their password with at least one other person. So again, I knew that was going on. I didn't realize it was so many. And then, probably in response to knowing some of this, Netflix is testing additional level of verification for their accounts. So they're now saying, well, okay, we recognize this is a problem. It's obviously being pointed out here, and what are we going to do about it? So Netflix is starting to make it harder to share Netflix accounts. The popular streaming platform is testing an additional level of verification for accounts. The alert offers the opportunity to join the service with a free 30-day trial, or to verify that you're the owner of the account by using a two-factor authentication system. The code is sent to the respective owner by SMS or by email. So just like when you would normally have two-factor authentication, you sign in and it says, okay, we're going to text you a code. Then you have to put in that code in order to access the content. If multiple people share an account, the person managing the account would have to forward the authentication code to the person who needs it. In the long run, this can be a nuisance for everyone involved. Yes, it would. It is currently unknown how often Netflix plans to conduct such checks. So, for example, if you're letting your child at college or your sister in Des Moines or whatever share your Netflix account, when they want to watch something, they're going to have to go, hey, can you send me the code? I want to watch something on TV. Yeah, that's a nuisance. So this may have an impact on some of the sharing. The funny thing is, though, that the message also shows the option to verify later. So at this point, they're not necessarily enforcing it. However, it is unknown how many times the message can be ignored, or if there's a high risk of being blocked. So if you keep ignoring it, will they eventually block your account? Will they eventually come in and say, okay, you really need to do one or the other? They're probably starting slow, and they maybe will roll this out in batches, as maybe enforcing it with certain numbers of customers, because they probably don't want to take a big hit, because they probably know that when they start enforcing it, they're going to have some people cancel because they're going to go, well, you know what, four families have been sharing this, or 2 or 3 or 4 families have been sharing this, and it's just not worth it anymore. So they're going to all cancel, or one person's going to cancel for everybody. So maybe they're trying to avoid that happening all at once. Or they want to see what the response is over time and see how they react then. Netflix responded, "This is a test designed to ensure that people who use Netflix accounts are authorized to do so. According to a survey conducted by Netflix, up to 50% of its users have shared or are sharing their accounts." So it is obviously a big problem for them, and I mean, it is basically like stealing, right? So it would be very similar to stealing cable or whatever else if you're not paying for the account, or you're paying for an account and then letting other people share it. And what's really like stealing, this really surprised me. I had no idea this was going on, at least to this level. This study said 58% of survey respondents purchased third-party SVOD login details and passwords online. So this would be people like, services like Netflix and others. People are selling those credentials. In addition to reportedly losing billions annually in lost revenue due to password sharing, new data suggests the black market for third-party login details and passwords is big business. Credential sharing continues to be a hot topic as more businesses turn to subscription-based revenue models. Redpoint's a brand protection services company surveyed 1,000 adults, and out of that, 40% of the respondents said they've resold. This is amazing to me. 40% of the respondents said they've resold their login details and password. Out of those that are using someone else's personal login details, 58% paid for the information online. I'm really dubious about that. I just don't necessarily believe that's possible, that 40% of the people, I just don't know how they conducted their survey, how scientific that was. That seems really high. I'm not as surprised by the sharing, family members and friends, but actually buying it surprises me. About 65% of respondents resell personal login and password information on social media, 64% resell on e-commerce websites, 56% on marketplaces, and 56% resell on end-to-end encrypted messaging sites. That's way over 100%. So maybe they're saying, people do it in multiple ways. So again, back to Netflix and their two-factor authentication, you can imagine how that might kill this market, because if you've resold credentials to somebody, and let's say there's, I don't know how many people, let's say you can have 4 accounts with Netflix, 4 logins and passwords, and if the primary account holder each time is going to get a text or an SMS that says, "Hey, we need to verify this," that's a big issue if you're reselling the credentials. So this also will help with that Netflix policy. So I would expect to see more, considering the size of the problem, I would expect to see more of these SVOD providers implementing some kind of check to make sure these are not being shared or sold, or at least to try to limit that. So what does the market look like? U.S. streaming video subscribers will total 385 million by the end of 2021, an analyst says. Now, how many of those are paying for the service and how many are just watching shared? We don't know. I'm assuming that's paid, right? Because that's how they can count. So out of that 385 million, how many subscribers is that supporting? Probably way more, obviously, than are paying for it. With new entrants like Disney Plus and Paramount Plus, the U.S. market could grow streaming subscribers even faster than it did in 2020. And of course, in 2020, we had the pandemic, so it grew pretty fast. According to UBS, the U.S. will have more than 385 million total streaming video subscribers by the end of 2021, up 50 million versus the 47 million total added in 2020. That type of subscriber growth would also be significantly ahead of the 43 million added in 2019 and 23 million in 2018. So you can see the trend, and I think that trend would be going up anyway. But with the pandemic and with more of the services coming out, like Disney Plus and like Paramount Plus and like Discovery Plus, this is going to be growing from that as well. The analyst firm estimates that in the U.S. this year, Disney Plus will report 8 million net adds, HBO Max will add 7 million, and Paramount Plus will add 8 million. Discovery Plus will add 7 million. So that's what they're projecting. I think they'll be off on that, especially with Discovery Plus. Even Disney I think Disney will add more than that. UBS estimates the average U.S. household subscribers to be 2.7 video SVOD services, up from 2.3 services at the end of 2019. I think they're low on that as well. I think that's getting closer to 4 now. What that means is the average number of SVOD accounts that somebody would have. For example, you might have Netflix, Disney Plus, and Discovery Plus. And maybe you have HBO Max too, because you get that free because you've got AT&T or something like that. So I think the SVOD is probably higher than 2.7 average. And I've heard that it's higher from other sources. they worry that the households could face subscription fatigue or reach a natural limit on the number of services they're willing to pay for on a monthly basis. And that's true, because as you start paying for these things, you start to realize, wow, I'm paying for lots of entertainment from different sources. So they're afraid that subscription fatigue will set in and people will start canceling that one or more of these particular services. Given the month-to-month nature of these services, we also believe it's likely that consumers could switch between platforms based on the timing of content releases. So for example, if Disney Plus is going to roll out their latest series, like Marvel series or something like that, people may sign up for it. And it's interesting because what Disney is doing on some of these, like they did with the Wanda series and with Falcon and I wanted to say the Snowman, Falcon and the Winter Soldier, I think it is the one that's out now. What they're doing is they're not releasing these all at once. So that does make it a little bit harder for somebody to say, well, I'm just going to binge watch this in like a month and then be done with it. So they're releasing it out week after week, like they did that with The Mandalorian. So you could wait until they're all out and then binge watch it. And I think I heard Netflix is going to experiment with rolling out a few series where they're not all at once. And that may be why, because people can, if it's month to month, and there's a particular thing that they want to watch, like the latest season of something, they could, as soon as it comes out, they could go ahead and order it, binge watch in a month. And the reason they might do that versus waiting is because you want to be, there's that whole word of mouth thing and being able to talk to people about what's going on. So interesting that some of them are looking at rolling things out not all at once, but in a series kind of format like we were used to with the old series. So even with everything looking good as far as the market goes, Viacom, CBS, and Discovery stocks plummet back to earth. So both of these stocks took a big run up after shares of Viacom, CBS, and Discovery saw huge run-ups earlier this year on Wall Street. Enthusiasm about their streaming strategy, stocks of both companies took a sharp downward turn Friday. Viacom, CBS closed down 27.3% for the day to $48.23 a share, which is high, but not where it was. Discovery dropped 27.5%, closing at $41.90 per share. Both companies had seen their stocks more than double in price in 2021 with the launch of new subscription streaming plays. Viacom shares peaked at $100 at Monday's close, giving it a market valuation nearly 25 times analyst estimates. So I think part of this has to do with being just priced really high. Discovery was trading at a multiple of 27 times EBITDA, earnings before income taxes, depreciation, and what's the A? I can't remember. Forecast with an all-time high price of $77.27 per share on March 19th. So if you look at their stocks, you can see that happen. This is over the last 6 months. So back here, 6 months ago, they were at $21.77. Then they had a big run up, and then they had gotten, looks like, up to $77, and then bam, down to, like, recovered a little bit, but down to $42. That's for Discovery Plus, basically. And then you got CBS, they're offering, and again, same thing, big run up, even higher, up to $100, and then dropping down to $45. So they're still, they're still up, but it really did, really surged and then dropped back down to reality here, I think. And then Roku also. Roku dips again, stock down 100 points since February 1, despite record Q4. So I don't know how much of this may be related to what was going on with some of these other streaming services, because Roku's been kind of hinting at and making this play that they're going to be providing more original content. If you thought about Roku, you think about it as a streaming platform and not really a streaming content provider. But they've been doing some streaming of their own streaming content through some acquisition and some other original stuff that they're doing. So Roku, which ascended to the lofty heights in early February of $395 a share price and a market cap of exceeding $50 billion, dipped to $295 a share as of late day Friday, NASDAQ training, and they're down even further now, I think. On February 18th, Roku reported that it finished the last 3 months of 2020 with a record $650 million of total revenue, up 58% year over year. So they're doing really well. You wouldn't expect their stock to drop like this, but again, it may be deemed as overpriced, and there may be some impact from the fact that people are saying, are they another streaming company? And are they going to be focusing too much on streaming? Roku Roku also saw a 58% revenue bump for the full pandemic year, taking in 1.7 billion, almost 1.8 billion. That surpassed the 1.6 billion guidance the company stated at the beginning of 2020. So they're exceeding expectations as well, but yet their stock dropped. Roku reported 65 million net profit for the quarter. Wall Street had expected a loss. And its active user count keeps surging, surpassing 51 million in Q4. So they're doing very well. So why is that the case? Well, again, I think, we'll explain here what their CEO says, but again, it may have something to do with these streaming services are just being overpriced. And you don't see as big a dip, as severe as you did on those others, but it definitely, it's gone up, started the last 6 months at 188, climbed up, as we saw here, to about 500, and now it's back down to about 300. So if you bought the stock back 6 months ago, you're still doing pretty well. And here again, they're responding to their people talking about them being maybe just another company that's going to provide SVOD services, and they're saying, no, it's not true. They say it's not about owning more of our own programming. Rob Holmes cites differences between AVOD and SVOD after buying this old house. So one of the things that they did was they bought this old house, which is some content that they could provide, and AVOD would be ad-supported video on demand versus subscription video on demand, where you have to pay a monthly subscription. With AVOD, you don't have to pay generally, or you pay less, but it could be, a lot of times it's like your traditional TV that you might get over the air, for example. After Roku bought the rights to this old house and the studio that produces it, Holmes said, it's not really about what we want to own, or that we want to own more and produce more of our own shows for the Roku channel. It says the streaming platform launched its first exclusive show, the thriller Cypher, so that was something they launched that was original. Last year they acquired the rights to programming from Quibi. That was that, it says here, short-lived, short-form subscription service, so very short-form videos. It also followed reports that Roku was looking to hire executives to manage original programming. So, as they say here, all of these breadcrumbs seem to lead to the notion that eventually Roku would want to have its own original shows. And that doesn't necessarily mean they don't, but it's, again, kind of lumping them in with lots of these other SVODs that are coming out, and how much can the market bear with all these people that are doing this. Holmes said that the Roku channel is free, a free ad-supported streaming service, or AVOD, network that makes it different from subscription-based SVOD services that don't carry ads like Disney Plus and HBO Max. AVOD is free, so if you're a consumer, you're not thinking about how much does this cost. Am I going to remember to cancel? That's always an issue. It's like, I meant to cancel that last month. How much am I subscribing to already? Again, that subscriber fatigue of having all these different services that you're trying to juggle and paying for. You're not having to worry about any of that. You're just really thinking, am I going to watch this? SVOD craves exclusivity. You want that expensive premium show that prompts people to find your service and subscribe to it and then stay month to month. So you sort of need that content. So what he's saying is they're not going to be as interested in getting original content. That doesn't mean that they won't provide some. That will help them get some subscribers. But when you've got something like a Netflix or a Disney Plus or an HBO Max, then you need something to draw people and to lock them in. That's why I was saying, you've got all these series coming out on Disney Plus, and you've got all the original content on Netflix. And then you've got HBO Max, which has, AT&T owns HBO Max, and they own Time Warner, or Warner Media Group, that produces the movies. So HBO Max shows fastest uptake in SVOD in the latest Hub survey, and that, I believe, is timed with about the time that Wonder Woman 1984 came out, and then also when they made the announcement that with this being a pandemic year, they were going to be releasing movies on HBO Max the same day that they were releasing them in the theaters. So this has caused consumers to jump in there with HBO Max to be able to get some of this content. More than twice as many U.S. consumers say that they now have the streaming service versus July, but they also say Max will be the first one to go when this pandemic finally ends. So again, people are getting it now, but at some point they're going to take stock in what services they have and decide what they're going to let go. 77% of 3,008 U.S. consumers ages 14 to 77 say they're now watching significantly more TV than they were before the pandemic, versus only 69% when Hub conducted a similar poll last year. So people are watching more TV here, even in the second year of this pandemic, declared pandemic. Only 62% of respondents said they subscribed to a traditional linear pay TV service versus 72% in July 2020. So the question is linear TV taking a hit from this? And actually, kind of back to the T-Mobile story, they were saying that that was a sign that linear TV is on its way out, that T-Mobile could make that work. But I think there's way more factors involved with T-Mobile. The Mobi TV thing, the 5G stuff, the fact that they had issues with their tiers and when they were rolling out programming and those kinds of things. So, but there has been a decline in traditional linear pay TV, as we see here, 72% in July 2020, and now only 62%. Uptake for all the major SVOD services is up, but none more than HBO Max. So we see here that they all have increased. They're all on the rise, but we do see that HBO Max took a big increase here again, I think timed with providing Wonder Woman 84 and then all the other movies that have been coming out on HBO Max at the same time that they're in the theaters. HBO Max is mentioned by survey respondents as the first service they'll quit. Hulu is also mentioned, 15%, and Discovery Plus, 14%, are also listed among the more expendable. And you can see that here. And you see Disney Plus at the top. People say 77% say they'll definitely keep, 7% say they'll definitely drop. And that's all about brand and content again. So Disney's the brand king. They have so many fans out there. We're Disney fans. You've got lots of kids that are Disney fans, obviously, because of that content. But you've got adults that are Disney fans. You've got all the Marvel content. So all of those things are propping up Disney's service. And as they have to continue to strive to bring out content to keep people engaged. Same with Netflix, same with these others. You got Prime Video. They do lots of original content, and they can leverage the free shipping. You get Amazon Prime, you get free shipping, you get video. So they have different plays here that help them keep people on the service. Then you've got down at the bottom here, you got Discovery Plus, and HBO Max that people say they're more likely to cancel. In February 2020, 34% of survey respondents described themselves as users of free ad-supported streaming services. That figure grew to 37% in July and now stands at 58%. So this is talking again about that increase in AVOD, or ad-based video on demand. So that is kind of back to that story about Roku, and that's kind of the direction that they're moving in. So they're seeing that as the opportunity. So maybe Roku stocks will rebound once people realize that, they're actually making a play for where people are moving. They're moving in this direction. And last story, Disney Plus, talking about them, set to roll out a price bump on Friday, which was, I guess, last Friday. So again, maybe Disney Plus looked at this research and said, you know what, people are going to hang with us even after the pandemic is over, and then maybe we can raise our price, or maybe they just know how popular they are. When they rolled out at a relatively low price, and they all tend to do that. I was talking about YouTube Plus. I think they started out, YouTube TV, started out at I think $45 a month, and now they're up to $65. So they start out low, get lots of subscribers, and then they bump the price up. So Disney Plus is doing that. They're going to increase the price for their standalone Disney Plus service from $6.99 to $7.99 a month in the U.S. You get it if you buy a year in advance. It's going to go from $79.99. It's going to go to $79.99 from $69.99. So they're raising that $10 per year. And the bundle that includes Disney Plus, basic Hulu, and ESPN Plus will rise to $13.99. So that's up $1. So that's not that much more. So that's really a pretty good deal. Where you can get Disney Plus, you can get your basic Hulu service, which I think has some ads on it, I believe, but it's Hulu. And then you can get ESPN Plus. So Disney owns all of those, obviously. They own Disney, obviously, but they also own Hulu and they own ESPN Plus, so they can bundle all that together for $14 a month. It's not a bad deal. Now, that may go up in the future, too, as they get more take rate on that bundle. Now, the company expects content spending for Disney Plus to spike between $8 billion and $9 billion over the next 3 years. So this is one of the reasons they have to raise prices, is because they need to produce new content, and they need to produce new content so they can keep people subscribed to their service. Because then all this stuff is month to month, and you're going to have lots of choices out there, and people are going to get subscription fatigue. So you need to find ways to keep them, on a month-to-month basis subscribed to your service. And new content, that fear of missing out, you've got, everybody's watching the show on Netflix or the show on Disney Plus or the show on Discovery Plus, and wow, now I need to subscribe to that. So they need that word of mouth and that fear of missing out in order to get people to hang on to their service. 2 weeks ago, Disney announced that Disney Plus had exceeded 100 million subscribers worldwide in just 16 months on the market. So they've been very successful. So as you can see, there's a lot of news and streaming, it seems like, every week now. And the reason is that's kind of the direction that things are moving. That doesn't mean that everybody's cutting the cord. Lots of people still get pay TV of some form or another. So this is just, new ways that people can get video. And I think over time we'll continue to see some decrease in linear TV, but I think we'll also see, we may see that stop at some point, because again, with all of these different choices, I think some people are going to want to maintain a base set of channels that they can watch at any time that includes a lot of different content, as long as it's not priced too high. The reason I think we've seen some of these vMVPDs like YouTube TV and Hulu kind of stop growing is because they raised the price up to now where people are looking at it and going, well, I dropped it, or I was thinking about dropping it because cable was so expensive, but now it's really, by the time I have my broadband connection and maybe the increased usage from that, plus adding YouTube TV or something like that, plus then I want to get Netflix and I want to get Disney, it starts to add up. So price is going to be the real key, I think, that determines whether or not linear TV and these bundled packages survive, and how much of that maybe is a combination, like we have with regular TV sometimes, a combination of maybe some paid and some ad-supported channels that can help fund all of this stuff. Well, thanks for joining me. If this was helpful for you or you enjoyed this, please give me a thumbs up on YouTube, and go ahead and subscribe if you're not already. Just hit the subscribe button. Make sure you click the bell, and if you click the bell, you'll be notified when I am live, which is every Tuesday at 3 o'clock, or any other time I might post a video. So thanks for joining me for Tech Tuesday, and I will see you next week. Bye-bye.